For more reaction to today's Fed policy, let's go to the Chicago Mercantile Exchange. Standing by, Bob Iaccino, founder and president of TraderOutlook.com, where he trades currencies, metals, and major indices. Bob, welcome to Bottom Line. Thanks for coming on today. We were just taking note, markets now at session lows, and Keith Bliss just told my colleague Matt Miller that for the Fed, this is fourth and long, is it?
It is, and it's really an indictment in a way of a somewhat neutered Fed. The Fed is at the end of the line as to what they can do to affect the economy, and the twist, even the aggressive twist, is really a shot at the area of the economy that they probably have the least control over given circumstances. Obviously, interest rates have affected, as you mentioned earlier, previous housing booms and recovery from housing slumps. It's not going to do it in this one with the depth of inventory we have, people still underwater in their homes, and it's just the stock market would have reacted to more quantitative easing, but that is also a short-term fix. So we're in a situation now where the Fed is fairly benign and neutered, and you're not going to see the markets react to this kind of a piece of news.
Does the Fed then have any other things at its disposal that it might use at this point, or is this it?
I don't think that QE3 is off the table, but I think it's on life support. I think it's dying. We have just a global economic situation. I was looking the other day at the dollar index, and the dollar index has crept above 75, 77, and is kind of hanging there right now. And that's troublesome to me, given the rest of the backdrop, because you saw the dollar index break out of that range, and it's just broken out of sort of a 5-month trading range. If it gets above and continues to rally, that happened in 2008 as the depth of the financial crisis really seemed to hit.
Right.
And if that trend continues, even gold was not a good place to hide during that. So you don't have it. Even commodities themselves were suffering. CPI is up, food is energy, transportation, they're all up. So without more free money and then some political solutions, we don't have a lot of luck coming in the short term.
Bob, I'll pose the question to you that I posed to Nigel Galt of IHS just a few moments ago. That $400 billion figure, was that about as aggressive as you thought the Fed would make a move?
No, it was more than I thought, actually.
Really? How much more?
It was about $100 billion more than I thought would happen. And that, again, that's a positive. You are seeing rates move. The TED spreads widened out in 2008. They widened out again over the past couple of weeks. That'll control the TED spreads a little bit, tighten them up just a little bit. You're seeing short-term interest rates rise a little bit. It also shifts some money from the public, from long-term into short-term, to get a little bit of less risk, better risk-adjusted returns. And then when that money matures, hopefully it flows into the economy.
Right.
That's still 2, 3, 5 years out.
Bob Iaccino joining us from the Chicago Merc. Bob, it's always a pleasure. Thanks so much.
Thanks for having me.
Now for more market reaction.